Welcome to Mutual Fund Talk. My name is Naveen Soni. The world is actually reeling through a really big problem, and it looks like that it will take time to recover. There are, of course, measures being taken by the government, but how will that turn out to be? How is India's macroeconomic growth poised? How is that going to affect a debt portfolio? And how can you build a fixed income month after month? How is it that you can actually create certain assets for your future, which keep giving you income? So that's what we are asking today. Maneesh Dangi is our guest. He is the CIO debt, Aditya Birla. He's joining us live from Mumbai. Maneesh, so much for joining us. My first question, of course, is on the macro front. How is the macroeconomic front looking like overall in all over the world? There's clearly a pause in the activity in the consumption. How do you really see things?
So, from a macro standpoint, the growth has taken a big beating. Right now, pretty much everywhere in the world, very tight containment measures are being adopted, to ensure that the virus does not spread, COVID-19 that we're talking of. And, for that reason, of course, the activity levels have actually dropped. Something of this sort we've never seen, at least in our lifetime. So the macro, purely from a growth standpoint, is looking very bad. This year, most probably the world would degrow by 2.5%. The developed economies will degrow by 5-6%, whereas the developing ones would also sort of stay flat or degrow. Somewhat lesser than developed economies. India most likely, would stay flat. So I think after 70s, it'll be the first year that, we will not experience any growth whatsoever in our economy. So that's on the growth side. The other part of macro, of course, is the inflation. That there is a complete decimation of demand. It's very likely that we experience very low inflation across the world. You would have seen what has happened to crude prices. They dropped to near zero, and now, of course, trading at $10-15. Pretty much all ferrous, non-ferrous commodities have seen sharp fall. As such, you've seen a fall in activity and fall in demand for even the most basic items in the world. So it should essentially produce quite a lot of deflation. Notwithstanding the fact that there are some supply disruptions also, because lots of factories are shut, and at least some of the basic goods which are in regular demand are in short supply in certain economies. But that's not true for India. So my base case assumption is that India would experience a sharply lower inflation in next couple of quarters. So that's the big picture macro. Growth negative, and inflation also very low.
So if you were to translate this actually to from an investor's point of view or a common person's point of view, now because this activity is up, there are of course industries which are under pressure, and there are layoffs which have happened, or there are salary cuts which have happened. Businessmen, particularly the small businesses, they have also taken a huge hit. So is it really the time one should look at creating some assets where you can fix income month after month?
Yeah, fixed income is for a common investor, should be simply as a very good, arguably superior alternative to fixed deposit. With characteristics that we've discussed many times, won't repeat them. So in a sense, fixed income is always a significant, important part of one's portfolio, both rich and middle income people. It cushions you in times like these. We've seen a significant drawdown in equities in last 3-4 months. Your equity portfolios would be sharply off, but if you were having a certain part of your portfolio in fixed income, in aggregate, your portfolio would have fallen a lot less. So
Okay.
its characters are very much like fixed deposits. Of course, it has advantages of better returns, better liquidity, and superior tax treatment. So
Mm-hmm.
my sense is that not only today, but fixed income should be part of your portfolio in all times. It of course depends on your risk appetite.
Mm-hmm.
What percentage of your portfolio should be in fixed income?
Mm-hmm.
If you want to be a very very conservative investor, then like my dad in late 60s, would have a significant percentage of his portfolio in fixed income
Mm-hmm.
only. But a person who is in mid 40s, like me, would rather have a substantial part in equity because I can bear the volatility of the markets. But yet, I would be wrong in actually putting all my egg in one basket, and that is equity. So even for me, at 25-30% of the portfolio should be in fixed income. As you grow old, a larger and larger percentage of portfolio should be in fixed income. Yeah.
Okay. So that's a very, very important number that Maneesh just said. He said 25 to 30% of your portfolio should be in fixed income. And because in times like these, that is what comes handy. And you can actually get some source of an income which can keep you going and which can actually give you some cushion in times like this when everything else is stalled, all the activity is stalled. Now, if one to actually build a portfolio for any such eventuality in future, if somebody doesn't have that kind of a portfolio, will it require a very, very large sum? Because to have a fixed income coming in, you'll also have to have a deposit or an investment which would actually give you that income. So if you could put some numbers for us as to how much may be required for, let's say, an income like 50,000 to 70, 80,000, which is the household expense of most of the common in India in middle to urban areas.
Look, in terms of the bar of investing, of course, in a fixed income fund is very low. So you could potentially invest even 1,000 rupees in a fixed income portfolio. Now, of course, you could look at a fixed income purely from a regular income standpoint and relate it with your expenses, and that in some sense, would presume what kind of returns would you make in a fixed income portfolio right now. Now, in times like these, when all sorts of interest rates are being cut across the world, investors should be aware that in the large part of the world, interest rates are actually zero or negative. And what's coming their way is that their neighborhood bank also is very like to reduce the interest rates on the fixed deposits that they've been sort of depositing their money in. And I wouldn't be surprised if your 1-year fixed deposit rates actually fall to 4% or below. Remember that a lot of these banks actually are being pushed by the regulators to actually reduce interest rates both for borrowers as well as depositors. They of course are struggling with their NIMs. So in such times fixed income portfolio, what can it offer? Its promise, remember, as I said, is the same, that it should do better than your friendly neighborhood bank. And so now, if your friendly neighborhood bank is going to give you 4-5% return for next 1 year, and you must talk to, of course, your advisors, but there's income funds which would give you a ballpark return of 6 to 8%, depending upon the kind of fund that you pick up. So that's a significant delta over what your bank would offer. That's one. Please remember that these funds are very liquid, so you can tomorrow, and a couple of days later you want to withdraw money, you can. You can withdraw. So it's very, very liquid. Three, you must also take into cognizance that the tax treatment is far superior to fixed income funds, especially if you stay invested for 3 years. Okay. versus what you would have to pay when you earn your interest in fixed deposits. So with all of them, actually, if we can convince our savers and investors to put more and more money in fixed income funds, they would be better than fixed deposits. Now, going back to your questions as to how much that amount should be, if you're going to earn, let's say, 7% return, so on accordingly, you'll have to rework what kind of money in lump sum you should be investing in fixed income to earn the kind of regular income that you want.
Okay. Now, people who actually are listening to this and they want to actually shift some of their money, let's say you said 25 to 30% into fixed income securities, they would also probably have to have a knowledge to start with. So if you could actually break down for us and our viewers as to what are the various kinds of fixed income securities that are available and what should one start with?
Okay, so we're talking about fixed income funds here, okay, not security.
Yeah. Okay.
That's point number one. And in fixed income, you have alternatives to all sorts of fixed income or fixed deposit needs that you have. Let's say if your money is actually lying in savings account, earning just 2-3% today, which most banks seem to be offering, you must move your money to liquid funds. Now, liquid funds actually are a good alternate to savings deposit. These instruments or these funds would right now give you, ballpark 5% returns. And like last 1 year, it would have delivered about 6% plus return.
Okay.
They're not volatile. You could come in even for 5 days, 7 days there. Okay.
Okay. So that's the minimum. And what could it stretch to? Like, would it be in months or it could?
No, so if that's what I'm getting to. So there are funds like liquid funds, that we offer today. They are addressing the need of an investor for even 1 week of investing.
Okay.
But what if you have 3-month money or 6-month money? Should you be still investing in liquid fund? The answer to that is no.
Okay.
Because you are making a sacrifice of actually staying invested for 6 months. You must demand more returns.
Right.
So therefore, our recommendation is that you should go to funds like low duration fund. Okay. Now, low duration fund would, if you stay invested for 6-12 months, would actually give you most probably 100 basis point to 200 basis point higher than liquid fund returns. Okay, in current environment. So you could sort of go to low duration fund as a good alternative to 1 year fixed deposits, which I said were very likely to trend towards 4.5% very soon. So whereas, these funds would deliver better. So that's the second product line, which is for your 6 to 12 months or maybe 3 months to 12 months of investing need. But what if you have a 3-year horizon, Should you still be investing in just low duration fund? The answer to that is no. You must demand even more returns because your money is there for 3 years. So you're actually, what are you doing as a saver is that you are sacrificing the liquidity for 3 years. It's not that, liquidity is not available. You can get out you want tomorrow itself. But then, because you are ready to stay put for 3 years, there are funds which are called short-term funds, which will deliver even better than low duration. Now, in short-term funds, you can talk to your advisor, and lots of fund literature available. But those funds are banking and PSU fund, corporate bond fund, short-term fund, or credit risk fund, or dynamic bond fund, which are for your 3-year plus investing. Most likely, these funds would actually out-deliver both liquid and liquid plus over 3-year horizon. So, what did we do? We took 3 steps. Your investment horizon is up to 3 months. Okay. We said, go to liquid funds.
Right.
Okay. And consider them as better alternative to your savings account, which earns you 2-3%. Then we asked you that, okay, if your horizon is more than 3 months and up to 1 year, we said go to low duration fund.
Okay.
And then, of course, if your horizon is more than 1 year and let's say 3 years and above, So then most probably you should go to one of the short-term funds. In
Okay.
short-term funds, we have variety. We talked about 5 sort of funds, but we right now are advising people to invest in corporate bond fund. Okay.
Okay.
So next time maybe we discuss, maybe short-term fund or banking PSU fund would feature in our recommendation. So in the bouquet of 5 short-term funds we are offering, we are actually advising investors to invest in corporate bond fund. That fund primarily invest in AAA securities and Government of India backed companies. Many of them are, as a percentage of portfolio, large percentage of portfolio are PSU companies and some government bonds. And this fund does not run any credit risk, and yet it delivers a significant alpha or significant differentiated return vis-a-vis fixed deposits. So, but that is for your 3-year investment horizon.
Okay, and for longer term, there might be some other products.
Now we're going into the territory that I don't have many people asking, but since you're asking, what about if you have a 10-year money? Then we have income fund, and maybe government bond funds. But basically we recommend people to invest in our income funds. If your investment horizon is 5-7 years and above, so those funds would actually arguably doing even better than corporate bond fund if you stay invested for very, very long term.
Okay, so they're also they have to compete with other asset classes like equity, or it could also be real estate, or it could be gold. So let's come to some other asset classes, because there is an expectation that equity might revive after some time, because the growth will be subdued for this current year, as you said. So if one were to factor that in, or I don't know if markets have already factored that in. So is it really a good time to stay invested or start investments in equity, because everything seems to be talking about doomsday? Or you would say that shift the 25-30% that you were talking about, and then maybe slowly keep investing in equities?
Look, when newspapers begin to talk quite a doom sort of scenario, and commentators are only making ugly comments about economy, this machine called markets may have already done its job, and you could actually look at something beyond what's evident today. What I mean is that perversely, when situation appears very, very ugly in terms of growth in our country as well as rest of the world, the variety of factors such as a large amount of government spending, sharp rate cuts, and stimulus being provided by both regulators and policymakers of all sorts, it's very likely that equity markets have actually bottomed. While our conversation thus far has been primarily on fixed income, I would advise investors to actually add equity a little more today than what they had in the past. It's very likely that equity would actually outdeliver over next 1 to 1.5 year more than what it is generally supposed to return to you for a long period of time. Unlike fixed income, what is the difference between equity and fixed income? Fixed income returns are in a very narrow range, okay? Like when you go to a State Bank of India and ask for a fixed deposit and it gives you, let's say, 4.5%, it actually exactly gives you 4.5%. So there is no range. It's an absolute specific point. When you come to fixed income fund, it gives you a range. It can tell you that, okay, my fund would return somewhere between 5 to 7 or 5 to 8. So there is a range, okay? But if you go to equity, the range is even bigger. Once in a decade, equity would give you -30, -40% also. But but couple of times in a decade, it will give you 25-30% annual return as well. On an average, they are supposed to return about 6.5% more than fixed income. But then what is the sacrifice you are making as an investor when you come in equity? You are making this sacrifice that you are ready to bear a large amount of loss in a particular year. That is not recurring, but it happens once in a decade or twice in a decade. Okay. So basically, over a long period of time, if you stay invested in equity, you would earn more money than fixed income. Okay, but then be prepared for the drawdowns or the losses that you will have once in a while. Okay, but that is precisely when, if you have the capability, you should actually dial more equity risk. Now,
Okay.
with this background, now I want to emphasize that this may be the year, after many years, after 5-6 years, that again a confluence of factors such as very bad economic data and extraordinary amount of fear may have led to a sharp fall in equity prices already over the last couple of months. But incrementally from here, for the variety of factors that I elaborated, which is policymakers, backstopping the economy, large amount of stimulus, low interest rates, would result in big reflation or big asset inflation over next couple of years. Large part of those gains would come in next 1 to 2 years. So therefore, I don't know whether I could explain this, but purely from the context of timing the market, you should be somewhat overweight fixed equity today, okay? And maybe a couple of years later, when equity has already extracted large amount of gains, you may want to rebalance your portfolio in favor of fixed income. So there are two sorts of investing style. One is a fixed asset allocation, okay, which that you are 45, so you can have, let's say, 30-40% or 20 to 40% in fixed income, and then 60 to 80% in equity, and always be like this, okay?
Yeah.
There is another investing style or asset allocation where you may want to time a little bit, okay, that when chips are down and valuations have corrected dramatically, the fear dominates the markets, okay, that is the time maybe you may want to add more equity. And when there is so much of bull talk and that everywhere, every newspaper, every TV, only talks about how great this country is, maybe that is the time, you may want to play a bit contrarian and, go a little bit underweight equity. That's a very, very, primitive way of looking at asset allocation. But, understand, that all other ways of doing it is actually spinning this on the same platform. So you may choose to be one of the kinds, My advice is that, if you are if you understand the broader macro and you have the guts and gumption to sort of dial more or less risk, you want to invest some time in that, maybe the second method could actually, deliver you somewhat more return over long periods of time.
Okay. Now, there's a general perception that fixed income instruments, they may have no risk at all. So we know that there are risks related to, let's say, interest rates, etc. But many people don't understand that or don't even know that. So they think, okay, they put their money in a fixed income instrument, and therefore they have no risk, no loss, only the income will keep coming in. So if you could just maybe clarify on that and elaborate on that a bit.
Look, there is absolutely nothing in the world which offers free lunch. Okay, so there is risk in everything, including fixed income. Depositors of PMC Bank would know that, and would rather much later got to know that, there is a risk in the fixed deposit. In Yes Bank's case, when the moratorium was put in place, people queued up in front of ATMs to only, really fear that they could lose money there. Of course, it didn't happen. So in a sense, there is risk in everything. It's about the kind of risk you want to run. Even as I said, your friendly bank, offers you a fixed deposit, but then, there are risks there, especially if you're not covered by deposit insurance and your amount of investment is, let's say more than 5 lakhs, you run a risk there as well. It's just that fixed income funds, most of them, okay, offer a fairly diversified portfolio. And as long as you're coming in for a right amount of time horizon, your risks are not too many and too much. You can sort of absorb them. Don't come to a short-term fund for 3 days. because in 3 days time, you know, for your 3 days of horizon, the risk in short-term fund may be too much for you.
So
But
the choice, of course, they have to also be accordingly done, right?
yes, so the time horizon of your investing has to be marked basis the fund that you are picking up. If you are picking up an equity fund for 10 years, I have to tell you this, that you arguably is running even lower risk than liquid fund. Because don't forget that in 10 years in an emerging market, you can have a hyperinflation and your real returns may get wiped out. So which is why it is important for you to and your investors and everyone to understand and simply answer this question first for me, that for how long your money is there for. If your money is for 3 years, then you should be in short-term fund. If your money is for 1 year, you should be in low duration fund. If your money is for only 10 days, there's no business for you to go to an equity fund. You should be in liquid fund. But if your money is for 10 years, then your large part of money should be in fixed income. So while we discuss about 30, 40, 50% in fixed income versus equity, the original answer is how long is this money for? If you have that answer, I have the asset allocation for you.
Okay, sure. Now, let's talk about the expected returns. There are some macro factors which, of course, affect the performance of the fixed income funds. Let's say for a shorter duration, people are now looking at 3 to maybe 6 months because this lockdown is right now currently on, and then things will start getting back to normal maybe a month after or 2 months after or a quarter after that. In terms of the life and routine, people are thinking from that perspective. Now, for a shorter term period, what would you say can be an expected return on these fixed income funds?
Yeah, I've given you a sense of what could be the returns, while we are not allowed to give a specific target return to our investors. Our regulator does not allow, and which is the fair point, because we are our funds are market oriented. Okay. So while I can give you a sense of a broader horizon, in terms of the range of returns that you could make in a low duration fund, as I said in the beginning, I can't tell you like State Bank of India or IndusInd Bank can tell you exactly what interest rate they're going to offer for 1 year. I can't tell you that. And which is why, we are, this industry is only 12, 13 lakh crore, whereas banks are 100 lakh crore. So there is an arbitrage because banks are allowed to tell you the precise level that you will get. That gives you a comfort. But please understand that you are missing on an arbitrage here, because just because we don't tell you doesn't mean, we will deliver you less. That itself is what is going to drive the returns higher. It's just that, since it's market oriented and regulators don't allow us to tell you very clearly how much return would you earn, there is an uncertainty. Yet I have to admit that if you are in a fund like liquid fund, I haven't, in last 20 years seen liquid fund, if your investment horizon is for 1 month, you're doing worse than savings. Okay, so you are going to earn, especially in the context of what is now in terms of what kind of asset allocation liquid funds have for last couple of years, you are likely to earn, much better returns than savings deposit. How much better, but so last 1 year, let's say an average savings deposits would have earned 3%. Okay, whereas the average liquid fund would have returned 6% to you. So you earn 3% more than savings deposit. But then you can tell me that, no, why are you giving me 1 year return? Whereas you're telling me to invest only for 1 month or 2 months. So on an average also, in last 1 year, every month, liquid fund would have returned somewhere between 5 to 7%. Okay, now I'm talking of range. I'm not giving you a specific number. Because in certain months, we gave you 5%. In certain other months, we gave you 7%. But yet, in every single month, it out-delivered the savings deposit. So that's the story of liquid fund. But here, please understand that your investment horizon, remember I said, is only up to 1, 2 months or 3 months. If you are there for longer than 3 months, let's say for 6 months or 1 year, again I have to repeat, low duration fund, Birla Sun Life's low duration fund, I think in last 1 year would have delivered 7.5 to you. So even better than, substantially better than liquid fund, okay, and substantially better than what you would have earned in a 1 year fixed deposit. Now that's past return. Mutual funds, can of course tell you what they've delivered in last 1 year, but they can't tell you what they will deliver in the future. But you can guess now that now low duration fund whose current yield is right now close to 6 quarter, okay, and we expect interest rates to go down. It's very likely that it would deliver better than 6 quarter or 6.5, okay, over next 1 year. So therefore, we could conclude that over next 1 year, if you invest in a low duration fund, it would deliver about 100 to 200 basis point more than fixed deposits. So you will have, so there is a bit of a roundabout way of answering this, You can't ask an equity fund manager, hey, you tell me that, you are going to make 6-7% more than fixed deposit. So does it mean because State Bank of India is giving me 5%, does it mean you will give me 12% fixed deposit? Of course, there are people who would have thought like this, but there is a root shock to them in last 3 months because they had a substantial drawdown in what you call returns, 25-30% losses. So you have to go and tell them, no, you have to stay invested with us for 5 years. Then most probably, on an average, over 5 years, your returns would be 5 to 7% higher than fixed deposits. That's very different than saying, listen, you're going to earn 6% more than fixed deposit next year. Not going to work.
Okay. So yeah, averages is what we can talk about. Now, you were also talking about the macro picture, and there are other asset classes. You said there has to be a certain percentage on the debt side, and then of course the equity. How about the other assets like gold, oil, real estate, the commodities, etc.? Do you think them performing decent over next some period of time, or do you think they'll be subdued?
Look, for majority of Indians that we are talking to, home or house is I would say not an asset class. It's a necessity. So, majority of them having invested in house is enough. Now, don't go beyond that. Try and look at only financial asset classes. Don't acquire more plots and more flats and so on and so forth. You would have seen in last 7-8 years.
Actually coming from you, because many people have been seeing, real estate as an asset class. Of course, it hasn't delivered the kind of returns that it was earlier. But
That's true. No, real estate is a big asset class. But I'm saying for majority of Indians, given that large percentage of your wealth is already invested in the home that you've sort of invested, or you build that house, now you must diversify and add more financial assets.
Understood.
And majority of Indians already have lots of gold. So, I have to talk down gold and real estate for them. But now we're talking to the group of investors who are super rich. Now, there are many other asset classes, they can exploit. And one such asset class, of course, a legitimate one is real estate. I think real estate it has had a secular bear market for last 6-7 years. And most government policies would ensure that real estate actually begin to reflate from here. But so for the super rich, I would advise them to start adding real estate if they are not overweight. Unfortunately, most people I know, they are overweight real estate. Everyone has 5 flats in Bombay. I advise them, don't do that. Okay, but if you are a rich man who doesn't have much of real estate, maybe it's time that you start to add, some real estate. Number 2 is gold. Gold is again for super rich. Okay. 5% to 10% of your asset allocation has to be in gold. But remember, your gold investment horizon has to be 10 years and above. Okay. Gold is a commodity and it pays off only when there are significant drawdowns in markets. Okay, which happens once in a decade. That is when gold cushions you. Okay. Gold is also a defense against hyperactive monetary policy and fiscal policy, which can one day potentially create large inflation, which will wipe out your savings if you're invested in fixed deposits of banks.
Right.
So gold again is a legitimate asset class for super rich to the extent of 5 to 10% with minimum investment horizon of 10 years. Okay. So gold and real estate both must have investment horizon of much longer than both debt and equity. Okay. Then there are many more asset classes. I know of people who are buying oil tankers right now. Okay. Because crude is available at $10-15. The carry cost, maybe another $10. And I think that, crude would be at $50-60 in about 2 years' time. So you can hold on to it for 2 years, you will make a killing. So, there are in Pacific and Atlantic, hundreds and thousands of these big tanks, floating around filled with crude owned by super HNIs, okay? The millionaires and billionaires. So there are many things, in terms, everything is an asset class these days. You can hoard copper because you will make lots of money. Copper is super distressed and, most likely you're going to have huge amount of infrastructure spending and, copper will reflate and would most probably go up by 30-40%. But, these are different asset classes fit for a super rich who have to diversify, who can look at illiquidity. Primarily when you asked me, the first thing you said is regular income. Oil tankers will not give you, these are speculative trades, Oil tankers may give you potentially a large amount of gains, but then, you could lose a lot of it. And plus you may have to stay with it for lot longer. So in a sense, those asset classes that, which is real estate and gold, much longer. And then speculative asset classes like commodities, I don't think it is fit for an average investor that you and I are talking to today.
Okay, so that's for the savvy ones and that's for the advanced ones for sure. But thank you so much, Maneesh, for joining us for today's session and talking through how one can actually create their portfolio in a way that you can actually keep getting the fixed income or the regular income, and how you can balance your portfolio. That's also very, very important. So in today's episode, we'll wind up here, but we'll soon be back with another episode of Mutual Fund Talk. Thank you so much for joining. This is Naveen Soni, your host, saying goodbye.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.